Jeffrey MacDonald is here, head of fixed income strategies at Fiduciary Trust, and Hank Smith, chief investment officer at Haverford Trust. Good morning to both of you. How do you read the issue in Brexit, the issue in China, and to the extent you think it's going to matter to the markets? Everybody seems to be liking things as they are this morning, if not more so.
Go ahead. I was going to say, I think the uncertainty meter just took a really big hit this week. I mean, everything in my world that was keeping curves flat and keeping yields down, we've made a lot of progress on it. I mean, we had the Fed earlier this week, last meeting of the year. They're unlikely to do anything next year. ECB, the transition to Lagarde, very smooth. Going to be a smooth transition there. I think with Brexit, I think with the USMCA, I mean, all of these uncertainties that we've been dealing with in the market have really all made big moves in the last week. So I think it's doing what it's supposed to do, which is encouraging risk assets, steepening curves, raising rates.
Yeah, this market has been acting in a most rational way, really, in my 35-year career. When you think of what it's paying attention to, which is what matters for long-term returns, low inflation, low interest rates, GDP growth, earnings growth, strong balance sheets, and it's ignoring all of the headlines that are often framed in a crisis, draconian manner, whether it's Brexit, whether it's income inequality, climate change, government debt, geopolitical tensions. It's ignoring all of that and just focusing on what really matters. And that's going to continue into 2020, in our opinion.
So the question, though, is should it? Meaning, I mean, you're arguing the answer is yes, as in that all of these issues are noise. And my question is, do they ever become more than that?
Well, the noise is going to become deafening in 2020 because we're in an election. And regardless of party affiliation, who's ever out of office is going to create a crisis environment that only their solutions can solve. But notice how in the Democratic campaign so far, there has not been the topic, the economy. The moderators never said, now let's turn to the economy, because the economy is in great shape and the consumer is in extraordinary shape, given that we're in the 11th year of an economic expansion.
I think one of the things you would see, though, is when we had the Tax Reform Act that came in 2017, that was very favorable for corporations. It should have encouraged a lot of investment. I mean, pulling forward all that depreciation, and you just really didn't see that business investment, and it was against the backdrop of all this uncertainty. If that goes away, I think the investment picture becomes a little bit more
I know you guys are playing for the long term, as they like to say, but we are in this sort of very strange end of the year period where there's lots of tax harvesting and all sorts of shenanigans going on. People want to be in certain names so that they show up on the forms next year, all of this. And we've had this sort of nice run, sort of Christmas rally of sorts. The question I would ask you is, do you have any anxiety or concerns that come January 1st that we could have a little bit of a lull, if not worse?
Yeah, our only anxiety is that the market has to have anticipated or bought into a little bit of next year's returns. So while we see a very favorable fundamental backdrop, particularly given these trade deals being completed, confidence will pick up. The economy should pick up off of 2%, but that's got to be a little bit priced in. So we're counseling moderate, temper returns. We still think equity returns will beat the alternatives.
And I think in the fixed income world, if you get this environment where curves are likely to steepen, rates are likely to back up, you could see a surge in supply now and even going into the beginning of the year to lock in some of these rates. And the other thing I would throw out there in terms of year-end issues that we started to see in September was this funding issue with the Fed and the repo markets being a little bit haywire. And is there enough liquidity in the banking system? I think around year-end, we're likely to see some more noise around that. So, again, in the fixed income world, that's something we're going to watch.
Powell actually addressed that, right? Powell actually said something about that. That these aren't weird moves.
He did, and he also really went out of his way to say this isn't QE4. These are funding issues. These are operational issues.
Yeah, they say that, but if you need to provide the liquidity,
well, there's
you're
the
not doing it
company
for that intention, for the intention of trying to loosen things up. But if you are providing the liquidity, you are still providing.
Yeah, and what's interesting about that is when you look at what they did, I mean, they're talking to the banking industry all the time, and they checked in around September and said, hey, do you have enough ample liquidity? Oh, we got more than enough. But here we are. Right. So there is some reluctance to put that cash back into the funding markets, take, T-bills in the repo market. So there's something about the attitude of these company managements with respect to the new regulatory environment that is gumming up the works in these funding markets. And, I think we're going to be dealing with that as we move into 2020. But it'll certainly be something we'll pay attention to going into year end.
And from an equity standpoint, they more or less said they're going to be on the sidelines for 2020. That has to be a positive backdrop.